No problem.
All right, against all odds, this is the Foundation's check-in for Thursday, April 27th, 2023. 3 seconds before we started, every single cable on my computer setup was yanked out when I accidentally knocked over the power supply and disconnected everything, to include the lights. I'm trying to put everything back together in the dark. So don't do that, you know. Let's see. Let me check in with you guys real quick. We got Greg and Brian here. Just a quick, 20, 30 seconds. How things going? How are you finding the course? Things going all right? I got your, I think you sent me one question, Brian. Greg, I don't think I saw one from you. Am I right?
I had one from
Yep, I
last
sent
week,
that one.
but you
Go ahead.
kind of answered it already just during the normal calls, so I'm
Oh,
satisfied.
so you're okay? Okay.
I'm okay.
I get we're running 2 or 3 different sessions and I'm trying to collect all the questions and I wasn't sure if I got them all. Okay. So Brian, how are you doing?
Oh, good. Thanks, King.
Okay, great. And Greg, you feeling everything okay?
Yes.
Well, I guess that concludes our briefing then. We'll see you guys tomorrow. No, so Brian's question was really to go a little deeper into the MACD and RedRiver relationship and why it's such a good indicator. I guess there's a couple things that really I find it very, very helpful for. I find it, you can get in the Army, we call it like target fixation, that if you've got a trade frame on a trade and you're trying to shoot at it, you tend, at least I do, we tend to get tunnel vision, and we're so busy looking at the tactical movement of price that that's all we can kind of see. And then if you are trading frequently, you end up getting transaction after transaction after transaction, and pretty soon all of this focus on really small windows, you might see oscillation in there, and you get a perception about how manic the market is, and you just get kind of burned out because you're trying to follow along. And what I've noticed is that, if we think about it from the sniper perspective, which is looking at 150 days, and then kind of an intermediate of 30 days, and then a 10-day, you get a tactical and operational, and then a almost strategic look at things. And being able to integrate all those into a single view to find out when all the signs are pointing to yes is really kind of helpful. And by that, what I mean is you get used to a certain tactical array. You've chosen the time frame that makes the most sense for you. Maybe it's 5 minutes. Or maybe it's daily charts. It doesn't really matter. You just have some kind of time frame that you've settled on as really works best for you. You like the speed at which the change happens. It's manageable but observable. You can make the decisions, gather your information, lay out the choices, make a decision, execute it, watch it starting to work, kind of refresh, start looking for the next. So whatever that decision cycle is, you kind of go through a period of time and then to the next one. And we get fixated on that. And everything that's happening inside that time frame, we're trying to make sense of it through our lens. We're looking at it through that lens, and I'm trying to make sense. And no matter what it does, I'm trying to find some theory that would allow me to explain what's going on. And I'm not satisfied until I have an explanation. And we think that allows us to go from a state of uncertainty towards a state of certainty. And what happens is you get all these rules, and they get very, very complex. And then as you start putting that complexity onto your screen, pretty soon it starts looking like my screen, and it's got goddamn indicators and all this shit all over the place. When in fact what's happening is that there is a certain passage of time in a lens, and there's all these different demographics of people that are looking at the market at some moment, and all of them making decisions on whether or not to act. And so if this was the long term and this was the, the 1 minute tactical guy, we might have some kind of time array that looks like this. And you might be working on the 1 minutes, and then you're used to working on the 1 minute. It has a certain battle rhythm. And then all of a sudden, something happens on the 30-minute bar that causes these guys who just been watching to start acting. And now suddenly their pile of money goes in and your pile of money, and maybe the 10-minute guy comes in. And now suddenly I've got 3 or 10 times as much money pushing price around. And from our point of view, that was just a sudden great big burst of buying in that 1 minute bar. It all hit at the same time for the next 3 to 5 or 10 minutes. All that money comes in and we think, oh, well, here we go. And then it just disappears. Well, all that means is that at some point, some guy with a big bag of money on this one came in and executed his position, and his at the 30-minute and the longer term guy, his bag of money is so much bigger than ours, it pushes the market around, and then it just disappears. Because maybe the move that his money triggered was not enough to make the daily bar or the weekly bar get activated. And so it just kind of stops right there. That's how much money went in and started pushing price around. But we're over here trying to make sense of all that inside of our screen. And then we make a little extra rules. So just in case this could happen, we might go back to the first few minutes before that and say, what was the signal that was happening in here that caused that sudden price spike? And we're going to try to find that in our time frame. But in fact, there was something maybe happening on the 30-minute or the daily or the weekly. It was just their time to act. And it had nothing to do with the tactical disposition of price in this little, because this is all noise to them. And so we think the price movements in here are causing things when in fact, there may have just been some kind of timing pattern or a decision that was made to rebalance a portfolio, to raise some money here in order to buy over there, and it pushes price around. So we get if we're not mindful of that, we end up getting very complex charts and very elaborate rule sets. And when all that's really happening is that the different time frames show up at different times and start acting. You see this especially easily in the Forex, where that market is open 23 and a half hours a day. And yet there are these little spikes and then a spike and then a spike. And that's just when the different global markets are kind of waking up and these guys are coming to work at the regular time and making their positions and doing whatever. Or somebody made a policy announcement in the morning and now these guys have to hurry up and act to rebalance their books. And so you get these periodic pulses and they've realized, hey, if I just divide that into threes, I can now act in a way that is sensible inside the right time frame. So if that's the sort of phenomenon that is pattern-seeking mammals, we're trying to explain everything through our lens, we might lose sight of the fact that it's just the different time frames starting to act for their own reasons. And the reasons why a guy who trades on weekly charts acts, whatever triggers him to act, whatever his trigger was, it's probably different than the guy who's working on 1 minute, who's got a super leveraged position and has to be very attuned to what the price and volume is in the moment. Whereas the guy at the weekly is really just doing a deliberate act of rebalancing as a result of some kind of, deep dive into research or whatever his reasons are. So that's the context that I want to talk about the RedRiver. So before I had the RedRiver, we had this price chart up in here, and it had various indicators and prices and whatnot moving around. And this was being driven by the 10-period regression line, the RL10 and the RL30, to a certain extent the RL90, the Bollinger Band 30 and 1 to set the river, the Dragon, which is a Bollinger Band 10 with a 0.5 plus or minus. So this, and then we start adding PSARs, and pretty, all of a sudden this is starting to get very convoluted. And what we wanted to do was get some sense of what is the higher, if this is the time frame that I'm working on, what does the higher time frame look like, and what is the lower time frame looking at on the same thin slice of time? So if that's time t plus 1, what's happening on time t, so that as this whole thing is moving forward, I get a sense of what the higher time frame, maybe that's the 10-minute chart, and maybe this is the 1-minute chart, maybe I'm trading on 3 minutes. How can I see what those guys are doing without having to change my time frame on my chart, and then try to remember where I am and then have to reset every time I change it? So that gave us the idea that we would evolve into an RL10 and an RL30, because that's 3 times slower than the RL10. And then we said, in order to look at the next higher time frame, if I looked at the RL90, essentially the 10 and 30 relationship is the fast and slow relationship that I want. So that if price is moving in a certain direction and then starts to move up, the RL10 tracks that pretty closely and then catches up, whereas the RL30, it really takes a lot longer for that thing to turn and move up. So now I get a fast turn and then a slow turn, and that keeps me attuned to what bottoming conditions really look like. The bottom really kind of looks like price in the RL10 turned first, the 10 crossed the 30, and eventually the 30 rolled up. And so somewhere in here, if I take the moment by the time the 30 finally rolled up and start with where the RL10 rolled up, that whole time process in here we might call the bottom. And there might be some jerking around inside here, but really when the longer term slower guy turns, then we can say, yeah, that bottom is in. Well, if on the time frame that I'm working on, that fast and slow relationship is done by the 10 and the 30, and I want to see what the next higher time frame is so that I don't get ambushed by his sudden appearance into the market, I could change my time frame and look at the 1030 on the higher time frame, or I could just multiply the 30 by 3 and come up with a 90. So if I'm looking on my chart, the relationship of the 30 and 90 on my chart is the same as the relationship between the 10 and the 30 on the higher time frame, as long as I have a multiple of 3. So when I go from 1 minute to 3 minute, I just multiply everything by 3, and now I can see what the 1030 looks like on the 3-minute chart without ever having to leave the comfort of home. Check or hold. And then if I multiply that by 3 again, I can get the 270. So now the relationship between the 90 and the 270 is that same 1 to 3 relationship, only that is now 2 time frames higher than my 1030. So now if I put all 4 of those regression lines on my chart, I now can see on a single chart, without losing my mind, I can see what my time frame is, what the next higher time frame is, and next 2 higher time frames, to see if some of those guys might be activated to bring their money into the market and start continuing the trend, or maybe smashing the change in trend in order to reestablish the earlier trend. So this is all part of an idea of trying to look at multiple time frames and different points of view and different reasons for acting without ever having to leave the comfort of my primary decision tool. Check or hold? That making sense so far? Okay. So now, one of the things that I can do with, if I have this as my tactical price target up here where I'm doing my regular decision making, what we decided to do was maybe instead of having all of those indicators on this chart, maybe I could have a simpler, smoother way to detect large trends and turning points. So if I was thinking of this like the ocean, here's the ocean and here's the shore. At high tide, this thing is up in here, and it's got a bunch of waves up in here, and that's my local volatility. But then when the moon changes or whatever causes the tide to, I don't know what I guess it's the moon or something. But at some point, the tide will shift. So this is high tide. And then when low tide comes in, this is going to be the surface. And here's all that move. So this move here is part of a natural biorhythm of larger forces that are moving the height of the water through a much larger channel. And if we're not aware of that, we might get caught up in the tactical moves and miss altogether the fact that this thing is moving on according to another cycle. So we wanted to get a sense of how could I summarize or synthesize all that information and bring it down to a simpler, smoother idea to catch maybe when the bigger trends were happening, the bigger turning points. And so the idea was we want to use the MACD, and the reason for that was simply because when we were studying volatility, what we did was we found a paper that took a look at, for the VIX, it was looking at a 10-period simple moving average versus a 30-period simple moving average. And it found that in the relationship between those two things, that you could mark off a chart of the VIX's behavior. It would be like sudden volatility spikes and then slow decay until it became very quiet, too quiet, and then a sudden volatility spike and then a long slow decay. And we knew that there was something like an average volatility and then a boundary of normal volatility, and that everything north of that would be abnormal volatile, and everything below that average would be abnormal quiet. And that we could learn how far this thing was going to go, and could we make that inverse volatility trade. And that was brilliant for a long while, and it's still a pretty good system. What stuck in my mind was that when we started expressing the relationship between in the 10-30 as a ratio, it led us to building the risk Z, which really looks like a MACD histogram, and because it is a MACD histogram that has a zero line. And we know that based on the relationship of volatility, that when it is below the zero line and decaying, if that's when price is exploding to the downside. There's big sell-offs, huge volatility, lots of fear, drives the VIX way up in a hurry. And then we treat that as the winter time, a great time to be short, not a time to start getting long. But then when that invariably rolls over, because that volatility cannot be sustained forever, then eventually it rolls over and becomes the spring until it gets to the zero line. And then if it continues into the growing season, it becomes summer. And when that rolls over, it becomes fall. When you better be harvesting, and you might get a second growing system like summer, fall, summer, in which case you have almost like a Kata 2 and it's great to the upside. Or that thing might come back and just come down and test the winter. And then once it gets into the winter, you better be out of your long positions and be ready to exploit the short side. And then if it goes to winter and starts to curl up and becomes spring again, you're ready to start planting. But if it ever goes winter, spring, and then rolls over into winter again, you have an amazing short side indicator. Those second legs always catch people by surprise. So you want to be adding positions or re-entering if you see summer, fall, summer. In the same way, you want to be adding to your short positions if you see winter, spring, winter, or re-entering the short positions. Well, what that got us into was thinking about the MACD as a really nice, smooth oscillator that would allow us to approach the market seasonally. And the risk Z was already using the 1030, so it was a natural thing for me to then say, well, I'm using the RL10 as the price, the smooth price. I said, I bet you if I use the RL10 instead of the price, and then use that as the input to construct a standard MACD histogram, and then instead of using 12, 26, and 9, why not just use the thing that I'm already using, which is the relationship between the 10 and the 30? And so let me use a MACD of 10 and 30, and let me use a shorter smoothing constant of 5, and let me just see what happens if I put that on my chart to simplify and smooth the tactical price down in here. And as soon as I put it on there, it worked like a champ, the same way that we got the risk Z to help us understand broader market conditions. So the MACD histogram was thus born. And the reason why we use 10, 30, and 5 was nothing more than it made sense to look at to have the same drivers of trend relationships down here as it did on the actual price signals up top, because we were using the 10 crossover 30, for P1s and COTA 2s and stuff like that. So it made sense just to start with those two same periods to see if that gave us insights, and it turned out to be very actionable. And then the idea of the 5-period smoothing constant simply made it more active, more sensitive to changes in big trends than using the traditional 9-period. So that's how we got to the MACD. That's how we got to the 10, 30, and 5. And that's how we got to the idea of trying to make it similar to the way we were already using volatility to come up with market conditions. So far, so good? Greg, you're okay? Okay. So now I want to talk about the RedRiver. And the way I want to do that is sort of, if I take a look at the RL30, I'm going to start with the RL30 because I think that's the most important of the regression lines. I think of it as the health of the trend, health of trend. And we're using the RL10 as the price. It's a smooth price, but the RL30 is the most important of the indicators, I think, because it's the health of this trend. And so you'll see that like the RL30 will go through these very smooth oscillations. And in the owl pattern helps us understand this bottoming behavior. You might say, somewhere in this bracket, bottoming is occurring when the downward slope starts to decay a little bit until it reaches its absolute lowest point, and then it starts rolling up, and then maybe this will give us the cup and handle. So what I like to do is think about all this as if I could find the midpoint, I don't want to wait for the cup and handle and then start buying here, because I want to get this. I feel like the harsher and steeper this was, then if that was an anomaly, then the more likely buyers are going to come in and start driving this thing back up to something like fair value. And then that's where the cup and handle pattern comes in, is the thing completes the cup and then does a pullback to clear the deck so that everybody who bought on the way up has a chance to get out. And then the buyers come in again, and now you have this Kata 2 type formation where you have higher lows. And then once it clears this previous peak, then it's like an emerging dragon and it's free and clear. So I say all that just to say that to me, the RL30, the black line, is the most important one because it's the health of the trend. And then when you look at the owl pattern, the fifth and final indicator in the owl pattern is when the slope of the RL30 is positive. It bottomed out and now the slope value is starting to rise. There were other things that had to happen over here prior. But the last and final one is the RL30 of the owl increases. So when you're thinking of, a line that does this, and you have somehow detected regular action, you might say, look, this period here in the middle is the real part of the trend, and then this is where the trend changed, right? So I might say, if this was the actual maximum adverse move of the slope, and now it's starting to get better here, at some point I have to make a definition of when is it good enough to say the bottoming period is over and now it's time to start buying. And then up in here, I got to say, when does this thing have to start curving enough that I can say the good period is over and now the turning point is happening? So you might think of this as the normal portion of the curve. And if I could say something like 2/3, 1/6, and 1/6, that now allows me to say, if I could somehow put a risk box on the bottom 1/6, and then if I ended up giving back the top 1/6, so if it rolled over and came down and hit my trailing stop, I could still get 2/3 of the move, and that might be two chunks of 1/3 or four chunks of 1/6. And now what I have is something like, the middle 2/3 is the same as the, having 4 out of 6 in my growing season, and then I'm giving back a little bit on each edge of the curve. So one of the things we actually try to do with the MMRB is the idea that we started off with the frog box, and then we slowly started compressing that into how small could I make that risk box and still have it manageable, that I never took more than a 1 hour loss. If I can do that here, now suddenly I can be long. And then by the time I was normally long after the frog box here, I now have the ability to get this extra piece. I'm not waiting that extra piece for confirmation. So what we're really interested in then in this whole extended discussion is I'm looking to somehow figure out how can I keep pushing the turning point definition lower and lower to where it matters. All I'm really trying to do is say, when has the trend changed? Well, if I now use the MACD histogram, and now I'm finally going to answer your question, if the RL30 is my turning point, and that's the health of the trend, I now look at the fast price. The RL10 is probably doing this. Let me try to draw that better. I'll try to make it look like a time series. So my RL10 through time might have been looking like this. Yeah, that's better. Might have been something like that. If I now draw a trend line around that, that sort of contains that, I realize that what I have is oscillations within oscillations. And while this thing is in a downtrend, what I'm noticing is that my lows keep getting lower until the point where they don't get any lower, and then the lows start getting higher. And this is where we start thinking of, well, I guess right about here is where that trend changed from down to sideways to up. And this is where the idea of trying to find Kata 2 formations inside here, before that becomes an emerging dragon, the fact that I've got a higher low tells me I can get started on this curve sooner instead of waiting for the absolute confirmation of a breakout from a previous high. I can relax that criteria and I can enter here instead of here because of the information that the higher low says this thing is tilting up. And that's the argument why you can get a Kata 2 instead of the emerging dragon. You can still get the emerging dragon, but you can actually get the Kata 2 sooner. And so now I'm prepared that as long as that upward trend is in play, I can just keep buying Kata 2s, either as re-entries, like if that rollover got me out, then I can just, when it rolls back up and made a higher low, I can just get back in. But if that didn't get me out, maybe the like on this one, the sell-off was not even enough to get me out and it already started rolling back up, I can add second positions when the sell-off never kicked me out. Check or hold. So what I don't want to do, and it's the same thing on the kind of on the bottom side, I can start getting Kata 2s in here, because as long as I've got lower lows and lower highs, I'm clearly in a downward trend. And then I don't have to get caught up in the tactical noise of the RL10. So that's already a lot of things to look at. So now if I'm looking at that in price for fine tuning my entries, I can now come down to the MACD histogram. I can look at the 10 compared to the 30 with a short smoothing constant. And now I can determine what is the broad overall trend. It's either above or below the zero line. And is the RL10 running away from the 30 or is it coming back? What you'll notice is that when you're in this sideways thing, the value of the RL10, the difference between the RL10 and the 30 is insignificant because they're both so close, because price is just kind of going sideways, that the amount of distance between them is so small that the MACD signal line is going to be very smooth. Depending on the direction of the trend, it might be slightly up or down, but it's going to be really small. So now if I take a 30 period look, 30 periods, and then I compute the standard deviation, and then I go plus or minus 1, I can end up putting a RedRiver around the MACD signal line, and then I can tell you if the current oscillation of the RL10 and 30, if that normal tide, well, is normal or abnormal, right? So here's what will happen. As long as that price is kind of moving, as long as the RL10 is sort of moving in a standard pattern like this, that RL30 is going to kind of be rising like that. And then the actual distance between those things are going to be pretty similar the whole way up. And that means that the MACD signal line is increasing because there's a positive, the RL10 is higher. So the MACD signal line is going to be constantly rising as well, but in an orderly fashion, in a smooth rise. And if I get 30 periods of very smooth rise, the RedRiver is going to be very close, and it's going to look like this. It's not until the if the price is moving along in it, I should do it in blue, sorry. If price is moving, in this case, the RL10 is moving along like this, up on the price bars, you would see the Z3 lines are going to pinch, and that's telling you that the price volatility is low. And that's going to tell you that the MACD signal line and its 5-period simple moving average are going to be very static. And that means that the RedRiver is also going to be very tightly compressed because the signal line, or because the MACD line itself isn't moving. You're going to get a very tight RedRiver. And that's going to continue until suddenly price is going to collapse. We would love to see it collapse. That's a great thing for us. And then up on the price line, or on the price chart, the 30-period moving regression line is going to start falling. But as long as this guy is failing faster, you can see that the distance between it is getting bigger each and every time, because price is falling much faster than the rate of change of the RL30. So what that means on our MACD line would go fast to reflect this rapid increase in the distance between the 10 and the 30. And after maybe 5 periods down, when you compute the Bollinger Band around that, you're using 25 periods of really tight relationship and then only 5 periods of significant pull away. Well, that just means that you're going to see a sharp move away from the RedRiver. It'll start getting wider because this distance is wider. But the price line itself is going to be a long distance away until the price kind of bottoms out, and then the RL30 kind of comes back in and rejoins them, and there they are. So now the price anomaly move is over. It went from a price value up here, and then it discovered that the new price was there, and it expressed that in a very volatile move. Well, the sharper and that move is, the bigger it is in the shortest amount of time, the more likely that was one great big bag of money that came in and caught everybody by surprise. That trade fired, a bunch more momentum things fired, and then nothing else fired to take it short. And then the buyers came in and started buying this thing on sale at the new discovery price. So that move is over. When that happens, then the signal line is going to bottom out, and what was in the winter is now going to start rising, and that means it's in the spring. So I look to see, when does it enter the RedRiver, and when does it leave the RedRiver? And now what it has done is crossed the normal. This was the old normal. This was the new normal. And then when the MACD line crosses that, the new normal is now the old normal, and this was the ancient normal, and now this is the new normal. The old boss the same as the new boss, the same as the old boss. Well, this marks off the change in the seasonality, and the sharper that move was down, and the farther it has to go to get to the zero line, when I certainly want to be long, because I want to take advantage of the summer season, my discussion now is, where in the spring can I start buying? So if I have this sharp move down and then the Red River comes down and looks something like that on the MACD, I now have these observable turning points on this hairpin curve. I have the point where the winter turned to spring. I have where it in the spring entered the Red River, hit the midpoint, exited the river, and now this is sort of my entry of last resort in the spring. I still have that much growing time in the spring before this thing officially becomes summer and then everybody starts piling on. Check or hold? What you'll notice is that the sharper the sell-off up in price, the harsher the winter on the MACD, and the farther it pulls away from the Red River, and that the farther down it goes altogether, the Red River gets wider and wider and wider until such time as that MACD signal line comes back in and hits entry, midpoint, and leaves, and then the turning point has been in. So when I look at that indicator, I'm looking for turning points in the Red River to see when the seasonality is changing. I'm looking to see how steep the MACD signal line slopes are and when it reverses. I'm looking for the seasonality. And I'm also looking basically for this kind of formation, because if I'm being conservative, well, if I'm really conservative, I can just wait for it to cross the zero line when everybody can see that we are back in the summer. But if I'm being reasonably conservative, I can start buying program here when it's still in the spring, but it's out of the Red River to the north. Check or hold? Clear on that, Greg?
Yes.
Now, what I want you to remember is that although this actually looks like a flowing continuous signal, what it really is just a thin slice of time, that every time those bars close, you get a new line segment drawn. And when you start connecting the dots, it looks like it's flowing, but it's really just a series of snapshots that we interpolate. Check or hold? Yes, Anna? So the zero line is always the difference between the positive or negative slope of that MACD. That's the crucial marker. And if I take, I'm going to draw the signal line, I think, as a orange. So you see it. So if this is where it got, I'm sorry, orange. If this is where it broke below the zero line, you can now see that I have a decaying market. So I interpret that as the signal line is, now I'm clearly in the winter. Remember, it's not really drawing those as data points. It's just one time period at a time. And then this is where it bottomed out, and now it was becoming spring. So when we actually see that line, it's all red, and then we might see that as a yellow line here. Now when I draw the Red River, maybe it looks like endpoint, midpoint, endpoint. I'm going to keep trying to draw it like that. And then if I drew that, you would end up seeing the Red River as the chart monkey draws it. And you would see that as sort of like a lava flow, and all that would be filled in. Well, what I want you to realize is that, remember, this Red River is simply a Red River is simply a Bollinger Band 30 plus or minus 1 standard deviation. So now here's the magic of this when you're looking at 5,000 symbols. And you have a system that is looking for prices in a trend of a certain type just as that big trend turns. All you have to do is compute the z-score of the MACD signal line with respect to, here's 0, there's -1, and there's +1 z-score on this time frame. Check or hold. Here is your z1, there's your z-1, there is z0. So if this was at z-2, I know that I'm 1 full standard deviation below the Red River, and I'm in the winter. So if you had 5,000 symbols, you might say, which one has the worst z-score plus the winter? I can now tell you which has the, relatively speaking, the worst adverse move of any other symbol, a shockingly big move that happened short, which is why the z-score will show how far away that MACD line moved from the Red River. It takes an extraordinarily bad, sudden, sharp surprise move to give you a terrible z-score. So if I got 5,000 symbols, I can just sort by z-score, and then I can tell you which one is in the worst condition. And if I go look at his price chart, I'm not surprised when I see a horrible sell-off, but I already know that. And from a single table, I can just compute z-scores and narrow it down amazingly. Now, if I do a time series, I can say which one has a z-score that's less than -1, so it's below the Red River, but it had an improvement over the previous z-score. That means last turn it was here, and it had the widest, worst z-score, but now instead of suffering, it actually improved. It's still out of the Red River, but it actually made a turning point, and that's how you find turning points. After a particularly horrible winter, I'm going to wait and see one time period of improvement, and then by finding things that have a z-score that's worse than -1, but better than the previous z-score, I now have found all of the symbols that are in that category, and now I can go actually look at the charts and start framing the trades the way I want to see them. Check or hold. And then I might use if I wanted to just find conservative exits or entries, I might just say, look, I want to find all of the symbols that had a z-score. Let's see, let me draw this a little better. Yeah, I want this one. Right now, this is a z-score of 1 and -1. This one has a z-score that is greater than 1. That little guy right there. Check or hold. But last turn, he had a z-score that was between 1 and -1. So I know he's in the Red River. But on this time frame, his MACD histogram improved to the point where it is above the Red River. So maybe I just want to find all of the symbols that look like that and then rank them by how far it is to the 0 line, because that gives me the biggest spring planting season of all the ones that have just become legitimate for conservative entries. Now, do you know how many people in the world are looking at the market in that way? Nobody. We are. So this is a way that you can sort 5,000 symbols and find the seasonality that you want. Early spring, late spring, confirmed summer, or better, summer, fall, summer, or winter, spring, winter. You can tell all that by these z-scores and simply looking at the MACD and getting the seasonality. So in our TC2000 bundle, we actually have categories where you can see which symbols are in which category. Like I like to use this one when I'm looking at longer term trends. Let me find, so this one, if I look at this is just the swing set, if I can say it that way. These are the monthly MACD seasonalities. These two in the middle are weekly chart seasonalities, and the last four are the dailies. So I can tell you, I'm interested in all four of the daily MACD conditions. Like right now, there's no symbol in this stack on daily charts that are in the summer. There's a whole bunch in the fall because of that sell-off, and then a whole bunch in the winter, but none are in the summer. So if I had a short side bias, I can tell you that I would be looking at, if I wanted to look for things to go short on, I would let me find the ones that are in daily winter. And I want to stay away from monthly summer because that thing has a residual long-term strength. But I would be happy to go look at treasuries who are in monthly spring and weekly spring, meaning that it has had sell-offs and is just tentatively turning, but the daily has gone negative. That's the one that is a candidate for winter, spring, winter. So treasuries are actually vulnerable, as is Tesla and clean energy and Intel. But the ones that are pretty good are these: Merck, Mexico, McDonald's, which are in monthly summer. Those things are long and strong as you could want, and they sold off enough to give them just a daily fall. They haven't even gone into the winter. So all things considered, just by that very simple sorting mechanism, I can see monthly, weekly, and daily, 4 seasons for my little tactical symbol set. And now at a glance, I can pick which kinds of charts I want to look at. Check or hold. All right. So all of that is the short answer on, no, it's not the short answer, but that's the deal with the MACD, where it came from, why we use 10 and 30. The final thing that I will say on that is that when working with Trader X, who's been my mentor for about 30 years and is running hundreds of millions of dollars professionally, we're taking a look at, instead of just 10, 30, and 5, we're using like 4, 30, and 5, because he likes to get that turning point even sooner than waiting for that one. It turns out that it might be a bar or two faster. It's a little noisier, but for our purposes, in my opinion, 10, 30, and 5 is okay. But if you're looking at like weekly or 9-day charts where each bar is a week, or each bar is 9 days, you can afford to be a little faster on the fast MACD. And so a 4, 30, and 5 works just fine on 9-day charts, weekly charts, monthly charts especially. Okay. So that's everything I want to say on that. And I want to get this thing, I want to get the recording processed and let you guys kind of sift through it. There was a ton of really good incremental ideas in there that will give you some things to chew on. And I'd like you to sort of digest that and then just keep feeding the questions to me. What I would like you to use is, when you send me questions to include in here, if at the front end of that you would put FQA, like in those kind of brackets like that, FQA, then I can sort for that just to make sure that I don't miss them. And that way I
Okay.
can set up the, the answers a little better. So just as a quick look at IYR, this happens to be looking at daily charts. If I went back far enough, you would see that, oh, here's where, just as a living example, I suppose, here's where the thing peaked, and then it had leg one and a rollover. Now I'm getting that, you can see I'm getting that long slope. Well, this used to be really good. And here's where it entered the fall. Here's where that went into the winter. If I could draw the straight line. And then it stayed winter all the way to here when it became spring. And you can see that was tentatively better. And then by this time, it's all summer beauty. Here's it goes briefly into the winter, but back into the summer again. So you get that move. Here's your winter move. And now it's trying to toy with, I don't know what, if it wants to go summer or go winter. This is an important turning point in that price. And you can tell that simply by this. But the fact is that with the RedRiver underneath the zero line, the primary trend is mostly down. That's still the dominant trend, is that if this thing starts collapsing, you can get short instantly in the winter. And then if it breaks below, 80, then that's a collapsing dragon. And then if it breaks below, 76, it's a double collapsing dragon. So this is how we can use that RedRiver. Like here's where it entered. This is where it clearly exited. So if I'm thinking about being on the long side, I can actually get long in here with a stop below the belly of the dragon. And even this little sell-off was not enough to chase it out. And now I get that extra little burst of spring and now all of the summer. And now I can start thinking about stalking the exit. And any exit you took in here, like when it hits the PSAR, you're happy with that trade on the long side, especially after having just lived through that. But really on the short side, the winter, spring, winter, that is the most massively beautiful short signal you could ever see. And guess what that is? PSAR flip and collapse. That's my number one favorite pattern for that very reason. And it doesn't even have to be all that big and obvious. Just take a look at this one. Winter, spring, winter. So now if I go north, there's my Kata 2. There's my collapsing dragon. That's the easiest trade you ever made right there. And when it starts to reverse, that thing was already showing you that it was slowing down by going spring into the RedRiver. The easiest mover when it's out of the RedRiver in the winter. Check or hold?
You're not actually putting the stop though on the.
Yeah, start that question again. I didn't have my headphones.
Sorry, you're putting the stop on price, right? You're not putting the stop on where
Correct.
the line current.
Yeah. The MACD has just given me sort of that smooth seasonal weather call, but I am using precise engineering of these turning points in the RL10 or the belly of the dragon. That's where I'm putting the stops because I want to be able to focus. But what this does is it allows me to use a very simplified view. I'm not even looking at price bars because this is just a continuous signal line. That's very smooth. In fact, my personal opinion is you can trade off of this and just blank out the price bars. Try sometime to turn the price bars white, or that'll drive you nuts. The lightest shade of gray that you can get away with, so that you have to really squint hard to see what's going on. And pretty soon you'll realize that the combination of the MACD and the two regression lines in Dragon is all you ever really need. like if we have just maybe I have enough time to do that in here. Let me see if I can see if I go let's see, where's my price bar? Now if I just come in and where's my drawing here? Like on this one, if I just said, hey, let me put my bar right there, and here's where the breakout occurred. So I just want to buy it approximately here. And I just want to use this as my risk box. I'm not even looking at price. And now if I go back and put the price back on this thing. I'm good to go. And now the price bars themselves are just little intraday noise, but I'm getting all of the big turning points correct here. You know, this one, there's your turning point. Here's a turning point. There's a turning point. Here's a turning point. It's nailing them. So if I can just use the space between the PSAR dot flip as my risk box, I should be able to just start sort of trading like that. So that should make your head explode. And
Awesome.
with
Thank
goodness. You are really going to like that lesson when you come back to it and enjoy. Okay. Yeah. So if you put that FQA in the subject line, like introduce in the subject line, just put brackets FQA, and then you don't have to put the question. I'll just put FQA and whatever date or foundations or something. Then I know I can just sort by that or filter by that, and then just collect the questions out of the email. And that way I have a permanent record of them. So that's everything I wanted to say for today. We'll get this published and posted, and see you shortly.
Thank you very much.
Yep.